All right, so in today's video, I'm gonna show you the strategy that I use to catch big moves like this one right here, catch high risk to reward trades in the Forex markets. The first thing that you should be looking to do is to find the market that is actually ranging just up and down. And this is essentially when the market is inside of a consolidation, because this is the essential part. And this is actually the first phase of the market that will lead to the huge movement that we're gonna catch once it does finally break out. We always start off by first finding a market which is going up and down inside of a range. It needs to be a clearly identifiable range. It should be very easy to see. Literally just draw a square, and if price stays within there for a long time, that's most likely an area of consolidation. Don't worry too much about the time frame. This happens on all the time frames. Just focus on multiple candles consistently trying to go higher and failing, and trying to go lower and failing. That's a clear tell sign the market is in a consolidation. So once you have your area of consolidation, then we want to move on to the second part, which is actually seeing a break outside of the range. It's either going to be below support or above a resistance area. Now, it's very, very important that once you get this breakout, you mark the area at which it broke out of, because that's going to be your area of support or your area of resistance. Because if it failed to break previously and then price finally is able to actually break below it, that is a specific area where the market is extremely likely to pull back into, and then we could take the sell. We're gonna go on to step 3, which is actually waiting for the retest. But before that, make sure you actually get candles closing below the area of support. A lot of people seem to think that a breakout happens when the market starts to trade below. No, it's actually when you get candles, whichever the time frame is that you're analyzing on, to close below support. So a breakout occurs once the candles start to close below support, not when price starts to trade below support. And the third and final step is to enter the trade off of the retest with an entry confirmation to confirm that it's the right time to enter. So right here, the entry confirmation was this bearish candlestick right here with a massive bearish wick to the top side. So what that wick tells me is that price is most likely starting to reject. It tells me there's a lot of sellers at this area of resistance. This is essentially like a supply area. And at this area of supply, price is most likely going to start going down. Now, as you see, actually the market went up one more time and it broke above the area of support. So it was just going up one more time before the eventual move down, just as predicted. And then the market continues on the bearish trend to the downside. This is a perfect example of an entry confirmation, this rejection wick right here. And this is also a perfect example of a market that was consolidating, broke below support, retested it into resistance, and then market continues to go down, giving you a high risk to reward trade. It's essential that once you do start to trade this way, you need to know where to place your stop loss, where to place your take profit, and that's what I'm going to be talking about today. And I'm also going to talk to you about how to avoid getting faked out, because if not, your win rate is going to go down and you're going to lose a lot of money trading. So there's a very simple way to do that, and that's exactly what we're going to get into now on the chart. All right, so first things first, this area of consolidation, as you see, we're here on the 30-minute time frame. So this isn't too much of a higher time frame trade. This can work on the 5-minute, 30-minute, and even the 4-hour time frame. It literally doesn't matter. The only thing is that if you're looking at an area of consolidation like this on the 4-hour, this would literally be weeks apart from this point in the market to this point. Instead, I would look at it on a 15-minute chart, a 30-minute chart, or a 1-hour chart sometimes. So the point is, you find your area of consolidation. Notice how the market here went from being in a bearish trend to then reversing to what seems to be a bullish trending market, but then we went into a large area of consolidation. Now, why did the market start to consolidate? Because we had a big movement. The market tends to consolidate every single time that you have a large movement. So it's essentially rebalancing itself after so much volatility and volume has been traded. Now, this is very easy to spot because you're going to go from a market that's forming big, clean candles like this into a market that starts to form an area of consolidation like this. If it's bouncing up and down for a long time, it's clear to say that that's an area of consolidation, and you could even mark it. You just type consolidation right here, so you know exactly what phase of the market you're into. And then once you do spot the breakout, you know it's a breakout because you're finally starting to get some signs of a trend starting to form. Label it B for breakout, and then now you know what phase of the market we're in. All you're simply doing at the breakout phase is waiting for the retest. You're waiting for the market to retrace back into an area so you can find an entry. do not enter in off of the break itself, because one, you're gonna have to hold drawdown off of the retest, and two, you have a chance of getting faked out. One tool that I use to measure the pullback for the third phase is the Fibonacci tool. So I've been using a lot the Fibonacci tool to get a general idea of where my 50% is. The 50% is the most common retracement before the market goes down. So actually, as you see here on my entry, the market retraced beautifully into the 50%. It retraced perfectly into that 50% right where this arrow is pointing. I took the sell off of the rejection, did go bullish one more time, just trying to trick us, but obviously we stayed in the trade because the market didn't really give us any real signs that it was going to reverse, especially because this can also be considered an area of resistance. So it still held this area, 2.25 200, even though we didn't hold 2.25 right on the psychological level, it was still held a little bit higher. So at that point, you can consider this to be the retest phase. And literally right off of that retest phase, the market shortly, I would say about 2 hours after, we were already very well in profit on this trade. Now, this was on the New York session. I get this question asked so often. When is it best to trade this strategy? When is it best to trade ride the wave? It's best during the New York session, but you can also take it during the Asian session. I do trade a lot during Asian because my entries, if they're not ready during New York, then they'll probably be ready for Asian. And most importantly, wait to have an entry confirmation. How do you avoid actually getting faked out? That's like literally the main point, because if you avoid getting faked out, you have a higher risk to reward, you make more money, and you can get funded a lot easier if that's something that you're looking to do. Have a solid entry confirmation. Because if the market retests an area and then gives you an engulfing candle or a big rejection candlestick wick or multiple wicks to the top side, if you're coming into an area of resistance, there's an extremely low chance and low probability that the market is going to fake out at that point. What could happen is that you will still sometimes lose a trade. That's perfectly normal. When you do lose the trade though, here's what it's gonna do. It's gonna come into profit. It's gonna start to have rejections to the downside, and then the market's gonna start to consolidate a bit before pushing to the upside. Or alternatively, it'll go down into profit off of this area of resistance. Literally, it'll stop right at the previous lows. So it's very easy to know when you're gonna lose a trade. And then it'll just reverse to the top. So I'm not saying that you're not gonna lose any trades, but what I am saying is that if you enter in with a solid entry confirmation, you're at least not gonna get faked out. Very, very rarely, you're gonna get a perfect entry confirmation like this, and then the market just jumps straight to the stop loss. Most of the time, it's going to at least go into profit. And that's the beauty of this third step, because it's literally what allows you to not take so many losses, and it allows you to actually manage your risk. So I'm going to draw on this right here. Let's say price comes to here off of this area of support. Notice how it kind of actually found support here. Price starts to literally just go upwards. This can happen, and this has happened to me many times. What you can do is you can start to manage risk, reducing a position size. So let's say you reduce position, reduce, and you start to reduce some of your position size in order to minimize the loss. What you can do essentially is reduce, let's say a 50 pips stop loss to like 25 pips loss. And I've done this a lot to the point where I was risking 6K on a trade, and then I only end up losing 2K or 3K on a trade where I was looking to potentially make 15,000. And that's where you get those insane risks to reward. And that's how you get high profit factor. And the worst thing you can do in trading is have those strategies where the market can literally just completely stop you out immediately. So let's say looking to buy here because the market had pulled back. The fact that this strategy is going counter trend and there's no type of entry confirmations on this strategy, even though it'll work sometimes, the fact that it does this means that you have no chance to reduce your position size before you lose the trade. It just immediately goes down. The good thing about our strategy is that we have so many confirmations that by the time we're actually going to lose the trade, we could potentially decide to reduce our risk. And even if we don't reduce our risk, we at least had some profit on the trade. So psychologically, it helps you perform way, way better. So I hope you guys enjoyed this strategy, and I hope you guys go out there and backtest it, implement it, and then go live test it in the markets and let me know what you think. I think if you can add some of these elements into your current trading strategy, it will at least improve your results and start to get you better trading results, higher trading profits, because at the end of the day, we want to catch these big movements. We don't want to be stuck in slow moving markets. We don't want to be stuck in the Forex ranging markets that happens most of the time. So what do? We spot the markets that are consolidating. We wait for the breakout, we wait for the retest, and we identify volume and momentum so we can catch the entire move down. That's what I've been doing, and it's been working extremely well for me. Make sure to watch this video that's gonna be right on the screen over here, and it's gonna make the strategy click a whole lot better. Make sure to drop a like, subscribe, and comment what you wanna see next.